So something we talk about market structure being broken. We talk about liquidity a lot of times. We talk about the market and what it's doing. And I think I wanted to put it together a presentation for y'all to give you really a better foundational understanding of what, when we refer to the market, what market are we referring to, and why it's so significant to understand the liquidity or the depth of that market. And so I put it together. I did put together a full white paper that I posted on the Discord and on the morning newsletter that went out. It's about 15 pages long. It's a lot more in depth than what I'm going to talk about here, but I think this will give you a good understanding. And one of the things we're experiencing is a lack of liquidity within the futures market, in particular the S&P 500. When I say liquidity, I'm talking about inventory. So think of it as when you go buy a stock or a option or a commodity or something, there is a market maker on the other side of that market, other side of that trade, and he or liquidity providers provide an inventory of S&P futures, in this case, that we're going to reference. And what we have seen since January 1st is a decline of 80% of the amount of inventory in the system. Now, we saw this similar kind of scenario back a year ago where we saw a decline of, I believe, 90% decline in inventory. And what that means to you and I is, think of it as you have an inventory of 100 future contracts out there. And that's normal. That would be a normal market, a full liquid market. But all of a sudden, 80% of that liquidity or that inventory goes away. And so now you have only 20 future contracts out there. But then you get an order or a sell order to sell, say, 100 of those. That's what we start to see in cascading selling or cascading buying, which we experienced yesterday. So right now, we are about 80% negative when it comes to inventory depth since the first of the year. And that's really keep that in mind. We have 80% less inventory in the market to buy and sell our stocks or other assets. And so what I put together here is to give you a basic understanding. There is two different things. First of all, there is what is called Essential Limited Order Book, and it is the real-time electronic ledger of all pending buy orders and sell orders, organized by price and time priority. It is the market. Now, there is a thing called a thick book, and that is a normal market, and that's where you have large orders can be absorbed across a narrow price range, orderly price discovery, so your stop loss fills near the target. So if you put in a thick book environment and you put in a stop loss, say you bought a stock at 10 and you want to put a 10% stop loss on it at 9, in a thick book environment, you will get triggered on that stop loss if the stock comes down to 9, right at that 9 price, meaning there's enough inventory to absorb your sell, or there's enough of a market there to absorb that. But in a thin book market, which is where we are today, the same orders push price through multiple levels. Gap down risk, stop loss skip past trigger prices. They move faster and deeper than headlines justify. So, for instance, what we saw yesterday was a prime example of a thin book. We were below on the S&P, we were below the 200, we were below the 50, we were in a negative bull bear environment, so we were in a bearish environment on the S&P, and then this news came out. And so because the book is very thin, there's not a lot of inventory, you saw this gap up in futures. So what happens is they pushed through, because we were in a negative gamma environment or a bear environment on the S&P, when we have transactions come through, let me see if I can bring it. Let me jump a little quick here. So to give you that positive gamma or bull bear fight line, you're in the bullish area. Dealers have to buy dips and they sell rallies, which dampens volatility. But because we were in a negative gamma environment or bear environment, market makers have to sell dips or buy rallies. Well, what happened yesterday? They had to buy the rally because they were in a negative environment. That's why you got this major move higher. But because there is less inventory for us to buy and sell in, because the inventory is down 80% since the first of the year, that gap up is a very thinly gap up. If it was a normal thick book, you would have not seen this move higher like we saw yesterday. This is a major risk. And so when I look at this thin book, what we saw was you saw short people who were short the market, they had a cover, but because the prices, the bid ask spread out so much because the book is thin, you saw this big gap up. And Mark just showed you a half an hour of charts that are all gapped up. And the reason they're gapped up was because there's not enough inventory for us to buy. So it forces the prices higher and higher. And that's when you get these gaps. And that is a very big risk, especially today when you have a thin book. We've had this major push higher. We've hit these resistance levels, as Mark demonstrated in a lot of the positions. Now there is no floor below it. Think of it as an escalator that went to the top floor, but there is no floor to catch it. There is no, we went from, ground floor to 100th, floor 100, but there is no in between. And that's the risk we're facing today. So the anatomy of a liquidity vacuum, uncertainty spikes. So geopolitical events, we had one with the Iranian war situation, data surprises or technical breakdowns hits the market in some way. Market makers withdraw. What this means is a market maker provides liquidity to the market. So a Citadel, a Goldman Sachs, a JP Morgan. Well, what can happen is they can get skittish like they are in this environment, and they will start pulling inventory off the market because they're concerned that the market something's going to go bad. And so when we go from, say, 100, my example of 100 future contracts, and now 80% of that goes away, that's the market maker pulling their inventory off the market. They're pulling their bids out of the market. So they're no longer providing liquidity in that market. So right now we're in a place where we only have 20% of what we had at the beginning of the year of inventory. And so these guys are stepping out of the market because they see risk in the market. They did the same thing back during the COVID crisis. You can see over here in the chart here, back in 2020, they had a market depth drop of 90%. So 10% more than we have today. It took 4 weeks for that to recover. During the tariff situation last April, 68% decline in the inventory in the market. Took 2 weeks for the market to recover. Today we're at 80%. We don't know where this is going to bottom. We don't know how long this is going to take to recover. But because we have only 20% of the inventory that we did at the first of the year, this market is not very liquid. And that's when Mark makes the comment about market structure is broken. That's what he's referring to. There is not enough inventory in the market for us to create a normalized low volatility market. And that's why you've seen the VIX in the chop bucket for so long now. Now, when books thin, this means larger price impacts. You can see single higher risk in remaining providers. Here's the problem: cascade acceleration. It's a feedback loop. You got a thin book, bigger impact, more withdrawals, flash crash conditions. And that's yesterday was basically a flash crash. It was a flash bull movement, but it was a crash higher. Now, when we saw back in, say, during COVID, or remember 2010 when we had the flash crash where we lost 9% in 10 minutes, that is because the 75,000 S&P E-mini contracts were triggered and cascaded this selling. Well, high frequency trading that we know now, these algo trades, they then jump on board that because they're triggered, and that's what causes this acceleration selling. Well, if they all of a sudden cause the acceleration selling, the market maker then, if it goes into a negative bull, goes into the bear side of the bull bear fight line, then they have to sell into it, which causes this massive selling. And we saw $1 trillion in value erased temporarily in 10 minutes in 2010. We saw a similar situation in 2015 in the China sell-off, and we saw it in 2020 because of market depth, or the inventory of the market was down 90%. So we're in this environment today where geopolitical events, for instance, the Hezbollah talks start tomorrow. That's an issue. We got tax day coming up on the 15th. You see people need money. Guess where they sometimes get it? They withdraw from the stock market. And then you got monthly OPEX. Now, in my paper that I put out the other day, or this morning, it goes into how big of a impact option expiration is. And when option expiration is, it a lot of times takes away the negative gamma. So if we're in a bull side of the bull bear fight, or bear side of the bull bear fight line, when options expire, they pull all of that out. So options basically accentuated what was normal, was just future contracts. So we're piling on more and more basically toxic waste, in a sense, in a negative bull bear or negative gamma environment, or bullish environment. So here's the thing about stop losses today. In this environment, because it's so thin, the market is so thin right now, your stop losses can see major gap down. So if we are in a thin environment and we see acceleration selling, and you've got a stop loss at 9, you could easily get triggered. That triggers it. The next market pricing could be $8.50. It could be $8. Just depends on how fast things sell. But because we have less inventory in the system, you get these major gap downs, or multiple layers down in when stop loss orders are triggered. If you're hedging, option-based hedging can really help absorb that. Having cash on the side, positioning size. This is, I think, where it applies to pretty much everybody here. If you have an enormous position in one stock that makes up the majority of your basically, portfolio, you're very at risk at seeing some major gap downs in your portfolio. And that's where basically managing your risk size, diversification through the amount of inventory you have within one position. Those are things that can really prevent. That's risk management. That's preventing the potential major losses. The problem we're in right now is speed. It's not direction, it's speed. We saw it yesterday where the market moved really quick. In a normal thick book environment, we would see a 1% to 2% over hours of time transact. In the thin book environment that we're in, we could see 3% to 5% losses or gains in a matter of minutes. And I think that, to me, is something that we need to think about. Understanding this invisible fault line is not about fear. It's about informed respect for the forces that actually move markets at the moment they move. When we understand what really moves markets, we get better at this.